Welcome back to Squawk Box right here on CNBC. We are just a few minutes away from the government's November employment report. Ahead of that number, let's bring in our jobs panel. Austin Goolsbee is here. He's the former Council of Economic Advisors chairman under President Obama. He's also University of Chicago Booth School of Business professor. Neda Issa is the former Deputy Assistant Treasury Secretary for Economic Policy under President George W. Bush and a Georgetown University Associate Professor. Javier Palomarez is president and CEO of the U.S. Hispanic Business Council. Liz Young is the head of investment strategy at SoFi. Karen Kimbrough is chief economist at LinkedIn. And our own Steve Leisman and Rick Santelli are here. Guys, we only have a couple of minutes, so I'm just going to ask very quickly, give me your number as we go around the horn on this. Austin, I'll start with you.
608.
608. Okay. Looking for a number that's up there. Neda, how about you?
I'm closer to 550.
550. Javier, you are back with us at this point. Let's see what your number is. What's your expectation? You looking for a hot number here?
Yeah, we are. We're north of 500,000 for sure.
Liz, how about you?
I'm going to say 600,000.
Okay. Karen?
We're in the 600,000 as well.
Okay, so everybody's looking pretty hot here. Steve, how about your number?
It's 650.
And Rick?
Just for the record, I'm going to go 490 and 4.4.
Wow. Okay. Playing by the Price is Right rules here. Rick's going to be in pole position to win, potentially on what happens with this. I want to ask very quickly, Liz, you had a very good point about this. You think the number was going to be hot, and you think the Fed was kind of expecting that. That's why you think we got the message we got this week?
I do think the Fed is expecting a good jobs report today. I think there's a few reasons for that. Number one, we hit a post-pandemic low on initial claims in November. Both initial claims and continuing claims trended down throughout the month. Some of the things that have been holding us back are services employment. And when you look at local government jobs, that had been causing the misses in recent months, too. I don't think either of those are a drag this time around. So I think the Fed was expecting it, and it knows the market can handle it if we start to think about a faster taper into 2022.
And Austin, give me 20 seconds. You were pretty shocked by what Jay Powell said this week.
Yeah, it really seemed like a reversal of the average inflation target type approach. I hope that's not right, but if he's talking about phasing down, tapering more rapidly, I understand that. If he's talking about let's tighten the interest rate, let's raise interest rates in the face of a supply shock, that seemed like a real change of tack.
Let's take a look very quickly at the futures and maybe pull up treasuries as well. You're going to see that the Dow is indicated up by 67 points ahead of this. It's been building through the course of the morning. S&P indicated up by 9. The NASDAQ indicated up by 44. And if you take a look at the treasury market right now, because this will be pretty key too, 10-year right now yielding 1.432%. That ADP number was a strong number this week, and that has the market expecting big things. Rick Santelli has the number. Rick, take it away.
Yes, our November jobs report is coming out. 210,000 on non-farm payrolls, a huge miss. 235,000 on private payrolls. And if we look at what's going on with regard to the change in manufacturing, 31,000. That's also a bit of a miss. Now let's get to the meat of this. And here is some good news. The unemployment rate, U3 as we call it, 4.2. 4.2. Keep in mind that if you go pre-pandemic, we were at 3.5 in February of 20 and 4.4 in March of 20. So arguably, we're testing those levels. 0.3 is your month-over-month hourly earnings. That's on the light side. And 4.8 year-over-year hourly earnings, also on the light side, but historically very strong. If we look at work week, 34.8 is the average hours, and that definitely ticked up about 1/10. And another very important number, labor force participation rate. We did see a tick up, 61.8. 61.8. That is a post-COVID high. Pre-COVID, in February, we were at 63.3. And finally, U6, our underemployment rate, moving big time from 8.3 to 7.8. That's also a post-pandemic low. Jobs light, a lot of the other metrics, came in about as expected. Some of them were a little bit stronger, like U6, the drop in the unemployment rate. We see interest rates haven't really moved that much. You see the curve actually wiggling a bit. You see more of a drop in yields in 2-year, at least for the moment, than you do in 10s and 30s. Maybe we'll take take out a little of that flatness, but flat is obviously the word on the yield curve. Back to the gang.
Thanks. Let's bring in the rest of our panel. Steve, I want to start with you because so much to dig through in these numbers. You heard that headline number of 210,000. That's a big miss. But looking at the unemployment rate all the way back down to 4.2%, below what we were sitting at in March of 2020, how do you read those two numbers and kind of mesh them up?
Becky, in 25 years of doing this, times 12 months or however long I've been doing it, I've never said this before. I don't believe the top line number. We have had a consistent situation of the BLS underreporting the payroll number, and it has been revised up. I'll just tell you right now, I haven't done the math. It looks like 102,000 added to the prior 2 months. They have consistently revised up this number. And I'm just not a believer here that job growth in the month of November was that weak. I'm very encouraged that we did see on the separate household report, which is not one that is massively revised over time, we did see people come back to the workforce and that big decline in the unemployment rate. I think I am not going to fall for it again when I did it back in August and September. And a video of me saying it was weak went viral. But the video of me saying there had been massive revisions to that weak number did not go viral. So I'm not falling for it. I'm reserving judgment here. I do not believe job growth was weak. And I've almost never sided with the household report over the payroll report. But I'm going to do that today.
Liz, I want to ask you, just as our markets expert here today, watching the market tick up on this, do you think it's because of what Steve is saying, that the market doesn't believe this weak number, or because the market's looking at the great unemployment number, looking at the weak headline number and saying, OK, maybe the Fed wouldn't move quite as aggressively?
I think it's the latter, Becky. I think there was a little bit of a mixed message here, and it gives the Fed a little bit more to think about, and we're not necessarily positive that they're going to hike rates so quickly. So I think the market is trying to work through those numbers, but the Fed is looking at the labor force participation rate and the unemployment rate, and both of those came in positively. So I actually think that this gives the Fed room to say we're still going to taper faster, and rate hikes are certainly not out of the question summer and fall of next year.
Javier, let's talk to you as our kind of expert and the person in the real world here who is seeing what's happening on the business level with these things, too. What do you hear from the companies that you represent? What's the biggest issues they're facing right now? Does it have to do with finding people to do these jobs? Is it supply chain?
Well, it's both, actually. But thank you, Becky, first of all, for having me here. I think these numbers, and everybody's positive about what's about to happen and what's going to be announced. I think that these job numbers indicate that despite everything, global pandemic, inflation, everything that we're hearing about, America's small business community is staying the course. We are the ones driving these numbers. At the end of the day, 2/3 of all new jobs in this country are created by the small and medium-sized companies, not the conglomerates. It's our constituency that are creating these new jobs. And we're going to stick it through. It is great to have this at the end of the year. I think it gives us a boost for a strong 2022. And we're looking forward, and we're going to just keep pushing and doing what we've always done, staying the course, creating the jobs, paying the taxes, and driving the American economy.
Karen, as LinkedIn's chief economist, you look pretty closely at the workers' perspective on all of these things. Do these numbers make sense with what you're hearing from your constituents, too?
Not at all. Not at all. This is the strongest single month we've had in the recovery to date, literally. And we're seeing hiring on our platform almost 6% above where it was pre-COVID. So I'm in the camp of I think these are going to get revised. I also don't think that the Fed knew what the number was, but I think they were very much hoping it was strong. And this is going to be a little bit more of a headwind for them to try to figure out how to navigate forward. Because I think they do want to be responsive to inflation, but the jobs number is not helping.
Austin, should I put you in that camp with Steve and Karen as well? Just the ones who don't necessarily believe the headline number? Or what do you think?
Well, I would say I have a theory, which is if you start your own company, you show up in the household survey as employed, but you do not show up in the establishment survey because you don't have any track record. You're not in the tax records. Mm-hmm. So as you come out of recessions, a lot of times, if you got a lot of new business formation, you'll see big revisions and you'll see a divergence in the jobs being created, they say in the household survey, above what's in establishment. This great resignation, I think, is in large measure the great I'm not working for somebody else anymore. I'm starting my own thing. You've seen record levels of business formation, and I think that's why these two surveys are splitting.
So what is the Fed going to do with this mixed set of data?
I think the Fed should be paying attention to what's real. And so if in the household survey that's what's real, that's what they should be paying attention to, the unemployment rate and the jobs there. But it just raises the degree of difficulty for the Fed to explain what it's doing. If people say, wait a minute, we're getting misses on the jobs numbers, why are you acting the way you are?
Hey, Kyle, let's take a shot of everybody in the wall right now, because I can see Rick shaking his head a little bit. I saw you shaking your head with this. And, Rick, I'm curious what you're thinking. Go ahead. Tell us.
I definitely think picking and choosing reports at this time, to me, sounds a little bit crazy, to be honest with you. Yes, we've had the household survey. We've had this survey. We all know that there's seasonal adjustment issues. But if you look at the 2-month revision in our rearview mirror, it was only 82,000 for the 2 months. And I understand, Steve, we always get the big February revision. Yeah. And I understand Austin. You know, it's called the birth-death model, whether it's going into recession, going out of recession. But to take it all on the surface, I just think we've trained people not to work more than we have in the past. And I agree. A lot of people stood home and did different things, trying to sell things on eBay, whatever it is. But that's going to run its course. And that's what we're seeing right now. That isn't the new way. That is the old way that worked for a while, just like the stay-at-home trade. And all of that isn't changed. That's why these numbers are light.
Well, just to add to that, look, you have a lot of women who were staying home to take care of kids who weren't out there, too. Once you change things like that, it's kind of hard to go back. If you've been thinking for a long time about potentially doing that, getting squeezed too tight on things, I would think that's part of it, too. Karen?
Definitely. I mean, we're seeing jobs that are remote as the most interesting jobs to anybody who's looking. So people are 2.5 times more likely to look at a remote job and apply for one. We're definitely seeing women in particular looking for that flexibility. So people got used to being remote. They got used to having no commute, and they like it. And I don't think they want to go back. But I will say, to Austin's point, we're seeing an explosion in entrepreneurial activity. A lot of people starting their own thing, striking it out on their own. So I think there might be something in his theory.
Steve, you've got some numbers that you've been looking through, too?
Yeah, I'm about to do the final calculation here, but I just want to respond to Rick, who I think in a very sweet way called me crazy, which is okay because I've been called worse. Here's the thing. What do you do? You have overwhelming evidence from a whole bunch of series. You have the ADP number. We have the high-frequency data I've been following. You have jobless claims coming down. I think that 199 was overstated by seasonals, but you're back in a sort of normal jobless claims number. You have a whole bunch of, you have all of these employers saying they can't get workers, huge amounts of job openings. And then on top of that, you have a series that has been revised repeatedly over time. And you say, well, what do you side with? I just think it's logical to say, you know what? Let's give it some time here to come back. And I'm just now calculating, Becky, the average revision, and it's been, 112, 148, 250, 185. Those are some of the upward revisions in thousands that you've had to this number over time. I don't know exactly what's happening. I think Austin's got a piece of it there, but I think the problem is inside the payroll report. I'm just saying the idea that you had some 500,000 or 600,000, 594,000 people coming back to the workforce. That's a big part of this story. It gives the Fed some leeway. I think it's still on track to hike next year, but I think it's an idea that you have people coming back, and you also have the lengthening work week, which I think is important too.
Netta, you said that the participation rate, that people coming back into the workforce, was going to be really important. What do you take from these numbers?
So I expected a decline in the labor force participation rate because we've been seeing high quit rates in August and September. But this is encouraging. I think the fact that people are coming back into the labor force is an encouraging sign. And I think that speaks to the strength of the labor market. I think one of the issues has always been, how do we get people back into the labor market? The longer they're out of the labor market, the harder it is for them to come back in. So I think it is. I think it's a good sign that we're seeing more people coming back into the labor force. We still have a ways to go. And I do worry that we might end up with a permanently lower labor force, given the kind of the trends with older workers leaving the labor force at higher numbers. So we'll see kind of it develops. But at this point, it looks good.
Like Jay Powell, you're concerned about inflation at this point. You say those inflation expectations, once they start to get baked in, are hard to shut down. What do you think happens next?
Yeah, so exactly. So I think we have to take this seriously, that we're seeing that small businesses are reporting that they expect to raise prices in the next 3 months. Surveys say consumers expect inflation of about 5% in the next year. Once that starts to hold, it could end up causing a drag on the economy. So I think the Fed is in a bit of a bind, but I think the balance should be towards inflation at this point. The labor market looks relatively healthy.
Javier, on that point, what do you hear from the small businesses that you represent, just in terms of what their expectations are for having to pay wages to get workers to show up, and what their expectations are in terms of price hikes they think they can pass on to their consumers?
Clearly, finding people and qualified people has been a challenge across the board. But we're finding them, and we're moving forward. Passing on price increases, I think that's something we're grappling with. Obviously, we want to stay competitive, but we have very few choices left. We have to continue to invest in our businesses. The number one challenge I'm hearing, bar none, is finding the right people at the right time. But there are some bright spots. I can speak specifically to MasTec. I sit on the board of MasTec. It is the nation's largest Hispanic-owned business. We employ some 22,000 Americans. We're an infrastructure company. We see opportunity looking forward. And we added some 5,279 jobs throughout this year in anticipation of the work that comes ahead. Seeing this infrastructure bill get passed is indicative of the kinds of things we want to see. We want to see stability. We want to see our elected officials working across the aisle to pass legislation and bills that make sense for the American people and for the American economy. So we remain hopeful. We're seeing, some positive signs. It is a difficult time for all businesses, and certainly for America's small business community. But, we remain hopeful, and we'll continue to face the challenges that are being thrown in front of us. Getting people back to work and getting the right people, bar none, is the number one challenge we have, though.
Understood. Austin, just in terms of those inflation expectations, what it means for potential for higher wages. I know the average hourly earnings came in a little lower than had been anticipated, but that's something people are watching really closely, because that is the key. Once it gets wrapped into that flywheel, how to unwind inflation. What happens?
Yeah, Becky, look, I agree with you, but I want us to always keep adding, but what about productivity when we say that sentence? Because we've had obvious increases in productivity. GDP is back higher than it was before the pandemic. The labor force is not back, so the output per worker has to be up. And if you have productivity growth, you can get wage growth, even robust wage growth, without inflation. So everybody keep an eye on what's happening on productivity before they conclude we're in a wage price spiral.
Hey, Rick, we watched the futures kind of pick up on all of this news and then come back to right where we were before we got any of this news. Maybe that goes back to the headline point that what really matters here is going to be what happens with the new coronavirus variant.
I think that's right. Right now, if I gave you a quick assessment, the short-dated Treasury yields are pretty much in line. We're right around 62 basis points in a 2-year. We're about a basis point higher in 10s. 30s are about unchanged. So, yes, market's taking it in its stride, and probably for exactly those reasons, is that the Omicron variant is the uncertainty here in the equation. And even though it's a horrible thing, all of this pandemic is a horrible thing, it really gave Jay Powell a free pass, so to speak, to be more aggressive on inflation and be more honest, I think, with the American public, because the American public knows. They know what's going on. How many times a week or a month do you fill your car up? How many times do you get the bill for your kids' school, whether it's private or college? These prices. I just had a furnace go out. I was shocked. I was shocked at how much some of this stuff has gone up in the last couple of years. So, yes, I think it's all about Omicron, and it's happening at a time where if it comes in as an easier to deal with variant, it's going to give a backwind to the economy that will help and kind of overshadow some of the issues that the Fed raised this week.
Steve, I see you've got your hand up, too.
Just real quick, I want people to understand the dynamic of what happened, at least on the household side of the survey. You had 594,000 people come back to the workforce. That's the largest we've had in quite a while. I could go back. But what's interesting here is that you had a decline of 540,000 in unemployed people. So a lot of people came back, and a lot of them went to work. You could have had, in this context, people come back into the workforce and not be put to work. So you could have had an increase in the unemployment rate, which actually would have been okay in that context. But what happened is people came back in and found jobs. I would just tell you this, whatever you want to take away from this, the dynamic told of the job market from the two different surveys could not be more different, where people came back into the workforce in the hundreds of thousands and found jobs in the hundreds of thousands. That's the household side. The payroll side, you had this trickle in and they went to work.
Steve, I mean, if I have to pick which story I believe out of those two, it's got to be anybody who came back into this job market finds a job, right? Because everywhere I look, there are, for hire signs.
And if you want, if folks at home want to Twitter that I'm a hypocrite, it would be fair, because I have sided with the payroll survey for decades, and this is the one time I'm making that just right. Hypocrite, whatever you want to write, go ahead.
Never mind. Yeah.
It's fine.
Austin, what do we make with this? I mean, the participation rate, I think, is going to be key. That's the secret to just about everything coming back, because inflation and higher wages are going to be tied to how difficult it is to find employees coming back into this market. But it also ties back to, the new coronavirus variant and how comfortable people feel. When do you think we'll actually get a decent read on this?
Well, as soon as we get a sense of what's the medical epidemiological impact of the Omicron virus, that's as soon as we get it. It can make our entire discussion here moot if it's extremely dangerous and has a rate of spread, an R0 value of 7. We're not going to be talking about big jobs numbers going in the future. We're going to be talking about, oh my goodness, now it's going to be like last fall. And if it comes in and it's milder than what people fear, I think Rick is right. It's going to give us a backwind, and we're going to be talking about strength. In this thing, the household survey has a jobs estimate each month. We don't talk about it because it tends to be more variable than the establishment survey. But it's usually a good idea to at least put let's call it a 15% weight on what's in the household survey. And in a moment where people are going out and starting their own businesses, I really think it deserves a little more attention.
I want to thank our jobs panel today: Austin, Netta, Javier, Liz, Karen, Steve, and Rick. And by the way, just for a wrap up on this, the jobs report came in with November a gain of 210,000. That was well below expectations. But the unemployment rate dropped to 4.2%, which was better than anticipated, and also below where we were in March of 2020 when this whole pandemic started. At that point, it was 4.4%. Gives us a little bit of advice. Thank you, everybody, for your time today.
Thank you.